The great unwashed, the almighty dollar, the pen is mightier than the sword. These are phrases that we've all heard. Where do they come from? Or more precisely, who do they come from? They come from Edward George Bulwer-Lytton. Apparently, he was more read at his time than Charles Dickens. That's hard to believe, but that's what I have learned. Unfortunately, poor Mr. Bulwer-Lytton has been savaged in modern times because he also wrote something else. Let me read it to you, ladies and gentlemen. It was a dark and stormy night. The rain fell in torrents, except at occasional intervals when it was checked by a violent gust of wind which swept up the streets. For it is London, that is where our scene lies, rattling along the housetops and fiercely agitating the scanty flame of the lamps that struggled against the darkness. It is said that that is the worst opening sentence to a novel in English literature, ladies and gentlemen. And they have a contest every year where they ask people from around the world to submit fictional opening lines that are awful, awful. I love it. And I'm going to read out some of them during the show. The point is, I bring this up because Jeff Snider, head of global research for Alhambra Partners, wrote the opposite of an Edward Bulwer-Lytton line. He opens so strongly. I love this line. I can't wait to find out what's going to happen. Jeff, you wrote, there is a precedence for this, though not to this extent. It has reached a record. Jeff, I want to know what's going to happen next. Tell us the story. What are we talking about?
Well, first I thought you're gonna put me in the same category with the poor guys, because I know anybody who writes for any limited amount or even a small amount will tell you opening lines are tough, and more often than not you're going to write crappy ones than good ones. The good ones are few and far between. So I think we could probably put a whole show in, really bad writing just in my catalog alone. So I thought that's where you were going, Emil.
I would never do. I would do that.
Maybe we should,
Jeff, but I would warn you ahead of time. I wouldn't do that to you without warning. Maybe the next episode. But I love this opening. I wanted to know. Whoa, a record in finance? What's going on?
It's kind of an obscure record, but I think it's an important one because it's something that we're all talking about. We're all hearing about, which is inflation about to be unleashed upon the world for the first time in a very long time? And when we start with some of the more visible indications like copper, so we've talked about that before, oil prices, which just seem to have no boundaries anymore, it looks like, hey, something's really going on here. There's an inflationary monster lurking. And oh, by the way, it's in the bond market. We're starting to see TIPS inflation break-evens break out to not just multi-year highs, which don't mean as much as they sound, but in the 5-year break-even, it's broken out to a decade high, which kind of sounds like, okay, something's really going on here. So what is it that's are we seeing inflation finally escape? Are we seeing all this money printing finally coming home to roost? Pent-up demand, all these other kinds of things, other kinds of issues which seem to be pointing in the direction, or at least the opposite of direction of where we've been stuck over the last 13 or so years.
Let me read out to you the 2020 winner of the award, the grand prize. Are you ready? Her Dear John missive flapped unambiguously in the windy breeze, hanging like a pizza menu on the doorknob of my mind. I love it. Forgive me.
I don't know if I've ever written anything that awful. Probably something close, but not that bad.
This is a masterpiece by Lisa Kluber of San Francisco, California. Oh, Jeff, you mentioned oil, you mentioned TIPS. We've talked about it in previous shows. Just very quickly, TIPS, they're inflation-protected securities, but not, inflation here. No, it's a specific consumer price index, and the consumer price index is tied to, or reflects,
largely crude oil. Yeah, it's crude oil prices. So you would expect that if you're getting paid by the CPI, you're going to pay close attention to what oil prices are doing. Because over the average holding of whatever Treasury inflation protected security, that's what the Treasury Department is going to refund to you, is what the CPI is on average over that period. So it makes sense that there's a close correlation between those two. And as oil prices have gone skyward over the last 3 or 4 months now, TIPS inflation break-evens have reflected that because of that CPI component. But where it starts to get a little interesting is that the closer in inflation break-even, say the 5 and 2 year, have gone much higher than the longer run inflation expectations, especially the 10-year. And that's really where we get to, we're talking about a record here. What we're talking about as a record is that typically you would expect inflation expectations to be hierarchical and orderly. They would be an upward sloping curve based on, predicated on time. So we would expect that the 10-year inflation expectation to be somewhat higher than the 5-year, and then the 5-year somewhat higher than the 2-year, and so on and so on. So that there's a hierarchy of inflation expectations that rise over time. But what we've seen since the early part of January is that as the 5-year has followed along closely with oil, the 10-year has now lagged seriously behind to the point where it's upside down. Inflation expectations at the 10-year break even are now significantly less than they are at the 5-year, which causes this, what I call inversion. It's not really an inversion, but it's sort of an upside down situation that's exceedingly rare, and it's at a level right now that has never been seen before.
Let me read another one, Jeff. When she walked into my office on that bleak December day, she was like a breath of fresh air in a coal mine. She made my canary sing. I think it's funny.
That was a good, actually for awful, that was good. And I think, I think you talk about canary in a coal mine. I think that's what we're talking about here. That's an appropriately horrible quote there, because what we're seeing is that the 10-year is not consistent with the 5-year. And then we look at longer run inflation expectations in terms of, the 5-year forward rate, which is really what the really drilled down distilled version of long run inflation expectations is. It has barely budged. I mean, yes, it's higher than it was last year, but it's still within this post 2014 trough, which suggests that long run inflation expectations have not changed despite the run up in commodity prices, especially oil prices and short term inflation expectations, which, given now this inversion in the tips break even curve, tells us that no, this isn't an inflationary condition. This is something else.
And Jeff, you mentioned that this is not the first time that it's happened, this inversion, but it's been a long time. You say that it's going back to the middle of the first decade of this millennium was when we last saw this. And like the middle 2000s, this inverted tips situation suggests the same thing, but in reverse. What did we see then, and what are we seeing now?
Well, back then in the middle 2000s, when the 10-year or the 5-year tips break even got above the 10-year, it was based on oil prices then too. If you remember that period in time, oil prices were rapidly moving higher, and it was the first time we had encountered $100 oil, or getting close to $100 oil. It didn't get there until later, but still, rapidly rising oil prices. And so you would think that, okay, here's an inflation expectation that's going to build and sustain itself. But what the tips market was actually saying is, yeah, oil prices are rising. There'll be some inflationary impacts in the short run. But overall, that does not change inflation expectations in the long run, because the market was saying this is a short-term phenomenon, and that largely nothing fundamentally had changed about the economy, which back then was a bubbly but yet somewhat normal economy that had a higher level of inflation expectations, but not an exceedingly high level. So in other words, even as short-term inflation expectations rose, longer run inflation expectations were relatively well anchored in a, plausible, rather benign position. Whereas today we see the same kind of thing happening. Oil prices are jumping up, but longer run inflation expectations aren't moving, which suggests that they aren't changing. But now we're not in a normal economy. We're in a well below normal economy, a disinflationary economy, which is the market telling you, yes, commodity prices are rising, but we don't expect that to have any longer run impact, because fundamentally, yet again, it doesn't change the outlook.
And ladies and gentlemen, the article that we were referencing right now is called Tipping Over, but Not That Way. And it was posted on the 4th of March at Alhambra Partners. Jeff, I'm going to segue to another article that links part of our discussion here. But before I do, let me give you a dishonorable mention. She sauntered into his smoke-filled office with legs that, although they didn't go quite all the way to heaven, definitely went high enough for him to see that she was a giraffe.
Okay.
Absurd. I love it.
That
I
might
love
be
it.
the best one yet.
Oh, by the way, who was that from? Oh, they don't. It was Jarrett Dement in Eau Claire, Wisconsin. Jeff, this is a good one that I haven't seen from you before in specific detail. We're now going to talk about the article, Reflation Amplitude, important, but what about frequency? And, well, just kind of tell the audience, what do we usually talk about when we talk about reflation? And then what did you look at? Which perspective did you take this time?
Well, most of the time we focus on, okay, when we're specifically reflation in the bond market, specifically 10-year benchmark treasury yields, because those are kind of like the proxy for what's going on overall. What we usually focus on is how high will yields go? If they're right now at 1.6%, will they get to 2%? What has it been like in the past? Where has the top in yields been over the last 4 or 5 reflationary episodes? And so what might we discern about the historical experience, and could that tell us something important about what's going on right now? But of course, there's another component to reflationary trends. Like anything else, there's also a time component. Not just how high can yields possibly go, how high have they gone in the past, but how long does this reflationary trends last? And that might be even more important question. How long should we expect this to go on? Because are we closer to the beginning? Are we closer to the end? Would we be surprised if it turned around tomorrow and this reflation number 4, if that's what it is, if that ends tomorrow, would that be completely out of line with historical precedents?
That's right. You ask 2 questions here. Would it be unusual if the current reflationary run was somehow brought to an end in the near future? Second, at the other end, from past experience, can we determine if there is some kind of maximum or ticking clock? I'm going to pull up a graph where you graph these, you measure, you set them all on a similar index or time period. You set them all equal to 0. What does the 0 represent? And then what do we see on each of the reflations? I'll pull up the chart now.
Yeah, for simplicity's sake, we're just measuring the 10-year treasury yield because, again, it's probably the best proxy for what we're trying to get at. And what we're looking at is, okay, if 10 years is sort of our proxy for reflationary periods, or even the opposite, if we set them to 0, the 0 is simply where they hit their lowest yield. Mm-hmm. And in Reflation 1B, you can see it's October of 2010. For Reflation 2, which followed it, that was May of 2013, the so-called taper tantrum that wasn't a taper or a tantrum. And then the current one actually bottomed out in last August 4th of 2020. What you see in these reflationary episodes I've highlighted here, obviously, first of all, amplitude, they've got much higher than we are anywhere close to now. But in terms of time, these are relatively short reflationary periods. I mean, Reflation 1B, what I call 1B, is what came from October 2010 until early 2011. And that was the QE2 sort of episode. QE2 falls entirely within that range. You can see that was over within a matter of a few months. That's all it lasted. Now, in terms of amplitude, you can see the 10-year treasury rose, quite significantly, about 125 basis points. So it was a significant sell-off, but it didn't take all that long. And after February 8th, treasury yields started to fall again. In fact, they would end up much, much lower over the next couple of years. Same thing with the 2013 reflation number 2. You see, again, it's a pretty substantial sell-off where rates started out, somewhere around 1.5 and got up to a little bit over 3% by the end of 2013. And yet from that point forward, for the next 2.5 years, yields again started to fall. And that was, again, only a matter of a few months. So on the shorter end of the historical scale, in the post-crisis period, what we see is that, reflations can be short and sharp and violent.
And so you conclude, as we end our article here, you conclude at saying that it wouldn't be a surprise if this reflation suddenly stopped. That sounds bad, but then you come back and you say, it could also continue, and that might be worse. Here, on the other hand, if there are no further serious monetary problems, this could go on for well more than a year, more than several years. And while the latter, what we're discussing, sounds like a much better proposition or a different one, in many ways, it's actually worse. I think that's people might not appreciate. Why is it worse if this reflation continues on for longer?
Yeah, it's a reflection of our focus on the amplitude rather than frequency. But in the long run, what matters is time. The amount of time we spent not recovering, not growing, not achieving actual economic health is far worse than the the amplitude of how much it gets in between. So when we go back, I mean, the perfect example is globally synchronized growth, reflation number 3. That was the longest one. It lasted from the middle of 2016 until almost the end of 2018. So, I mean, it was an extensive, really lengthy reflationary period, but all it did was squander that much in terms of time. We're talking about 2+ years wasted on, hearing about inflation, hearing about recovery, many people getting prepared for it. And then at the end of it was yet again another false dawn. So it was the worst case is more in terms of time than in fact the fact that it actually came up short, because I think we knew it was going to come up short anyway.
That last point, that's the key, Jeff. It's not like it was 2 years of rip-roaring good and then suddenly a shock threw us down. No, throughout, but at least from towards the end of 2017, things started to creak and crack that suggested it wasn't going to really happen. Jeff, let me read a final sentence from our contestants from 2020, all trying to get that grand prize of the worst fictional sentence to opening of a book. This is a dishonorable mention. Let me read this one. I thought you would appreciate this one. It's from Sue Doenim in England. Quote, "The quantum flux field of the post-Einsteinian hyperdrive has gone asymptotically, and we are in danger of approaching singularity as described by the Schrödinger equations," cried Captain Quirky, having no clue what he said, only knowing it sounded sciency, secretly crossing his fingers behind his back and hoping there were no physicists reading because he didn't want any pedantic letters saying it was nonsense. A lovely.
That was a good one.
Lovely
yeah,
contest.
every time you sneak in an asymptote, that's always good. That's always potential for both confusion and comedy.
Is there any confusion? Is there any comedy? Are there any asymptotes in China? That's where we're going to turn to next in part 2 of this episode, to see if some of the leading indicators, some of the monetary measures, what they're telling us about this current reflation.